All right, welcome everyone. Welcome to the Cointree and Cryptocate Tax Time webinar. Now, we'll just give attendees probably another few minutes for everyone to arrive. So I'll let you all know when we're starting very shortly. Probably give attendees one more minute and then we'll make a start from there. All right, well, good afternoon, everyone. We'll make a start now. So welcome to the Cointree and Cryptocate Tax Time webinar. Thank you so much for everyone who's joining us today. For those of you who don't know, my name's Jess. I'm Head of Operations at Cointree. And today we have with us Callan and Tom from Cryptocate. Welcome.
Thanks for having us.
Thanks, Jess.
We've got a very exciting session planned today. And I guess just quickly before we do start, I will just give a quick statement, obviously, about financial advice, and the information provided in this webinar today is for educational purposes only, and it does not constitute as financial product or tax advice. We recommend that you obtain independent advice from an Australian financial services licensee before making any financial decisions. All right, well, with that said, I'm actually going to quickly pass on to Callan just to give us a quick overview of Cryptocate.
Thanks, Jess. Yeah, my name's Callan. I co-founded Cryptocate in 2017, and we could see a big need for consumer reporting services in terms of taxation in the cryptocurrency space. Mm-hmm. So I've been working in that for a while now, and we've seen a lot of development, especially recently in terms of DeFi and some of the new projects that have entered the space. But yeah, Cryptocate, we do reporting for all kinds of investor types and different business entities in Australia. We work with investors and professional traders and self-managed super funds, as well as businesses. And we basically produce the end of financial year reports for their cryptocurrency components of their activity and make sure everything's up to scratch. So yeah, we handle a lot of different data from different platforms, different exchanges, and make sure that it's all accessible and able to be reported upon so that people can kind of reduce the amount of stress they have when it comes to their end of year reporting.
Fantastic, and that's exactly it. As an exchange, and I'm sure most of the viewers today know that Cointree, we are obviously a digital currency exchange, and we get a lot of questions from our customers. So I'm really looking forward to getting both your responses throughout the queries that are raised today. Just a couple of quick housekeepings as well. We will be doing our best to answer some questions if they do pop up during the conversation today. However, the majority of questions will likely be answered towards the end of the session. So please viewers, list whatever you'd like to know. We're going to run through probably about at least 10 top queries that we've got, and then we'll do our best to get through the rest from there. Just a little bit of context as well, for Cointree and Cryptocate. We've actually been working together to make your lives easier. We understand that tax time can be tricky, so part of today's session is to obviously unearth some of those questions that you've all got, and we'll also be providing, in addition to this webinar today, a comprehensive tax guide that all attendees will get emailed out tomorrow. So we'll be able to provide you with a little more information if you do miss any of the questions today as well. But that being said, I guess let's jump into it and take it from there. So our first question today is, what are some tips for minimizing my crypto tax?
Yeah, that's a pretty common question that we get. I think everyone's interested in minimizing that bill. Yep. I suppose there's a certain amount of, what's done is done in terms of the activity. So the activity that you have conducted as an investor, it's already been made. So we'll need to look at that and what's appropriate to handle it. But we approach the reporting process from a few different angles, and the main one that we can compute differently is the accounting method that we use when we look at the data. So there's three basic methods: first in, first out, last in, first out, and highest in, first out. So that's basically saying which cryptocurrency are we counting as being sold first. So in the highest in, first out method, we're selling the most expensive asset first. So in that context, it's most likely that it would minimize tax in a given year, because we're selling the most expensive, which means that the gain is minimized. But where that might differ as well is if we're looking at assets that have been held for over a year, which means they would have the 50% CGT discount applied to them. So in that case, it might be better to look at it from a last in, first out perspective, which would sell the most recently purchased asset first, meaning that we can realize those discounts on some of the long-term gains. I would also add to that in some situations, if you have an asset that's appreciated in value, rather than disposing of it and incurring a CGT event, you can also take out some crypto-backed loans, which mean that you wouldn't actually be disposing of the asset and incur a CGT event, but you could receive some of the fiat value of that asset back. So you'd have the capacity to access some of the liquidity without incurring the capital gains. Yep. Okay. Was there anything you wanted to add to that, Tom?
Yeah, look, just to add to a few things there, I guess it's really vital that good records are kept for any investor or trader. That just allows for greater insights to be obtained, and then obviously you can make better sort of tax planning decisions off the back of that. So Callan obviously highlighted, the parcel selection method can obviously dramatically change the tax outcome. Probably in addition to that is, making sure you're structured in the correct sort of tax structure. So obviously, probably a lot of people when they're starting out are just doing that in a personal, individual capacity. But there are opportunities to look at other structures like a family trust, or even a investment company or what have you. Can sometimes gain a better tax outcome. And then I'll just expand on obviously unlocking that liquidity around these crypto loans, where you essentially collateralize your crypto asset. And then you can obviously get some cash and get some liquidity. So that's not a disposal of your asset. And also the interest on that loan is also sort of tax deductible as well. So there's some probably pretty high level ways of in terms of minimizing some of your tax as a result of your activities.
Okay, no, that's fantastic. And I think coming from that then and stemming from that, we do get a lot of questions on how to determine whether someone's an investor or a trader. Could either of you provide some insight on that?
Yeah, sure.
Absolutely. Yeah, I think that it usually comes down to the kind of the intention and the pre-planning that comes in to the activity that's been taken. So if you're conducting it in a business-like activity, you've set up an ABM potentially, or you have some kind of strategy around your trading, then that might push you more in the realm of a trader. If you're buying the asset and holding the assets, and you're looking at your gains mostly coming from the appreciation of the asset, then it's more likely that you'd fall into the investor category.
Yeah, so just to expand on that a little bit more, so like characteristics of a trader, you're sort of looking at sort of repetition, volume, and regularity of that activity. So as a trader, you generally expect to see more similar higher volume, lots of transactions happening, thousands versus, maybe a handful as an investor. And then, executed via routine methods. So a big thing that the ATO look out for is kind of like, you've got a business plan, or you've got a sort of a set way of, how you're executing your trades. It might be, crossing over of a moving average, you buy and then you sell when a set condition is met. So that sort of starts to point you towards, you're organized in a business-like manner, you have a profit-making intention, you set up in a commercial way. Whereas as an investor, you're looking more this longer-term capital appreciation, as whatever it is in the crypto land, holding on for dear life or whatever. So you're holding through these longer market cycles, and you also might generate a bit of income. So you might be prepared to stake some of your crypto. You might lend some of your assets out for some interest. So whilst you can do large volume trading, so you probably see larger volume investing from an SMSF, for example, you'd probably see that more frequently. Like they might do 10 or 15 trades a year versus hundreds as a trader. So they're the sort of characteristics you look out for. So and then we'll obviously discuss what that means from a tax perspective. I think going down further into the chat.
Yeah, we've certainly had a couple of questions about capital gains and the level of trading and conducting small trades, and we actually will touch on that probably a little bit later on as well. And a couple of queries about some DeFi entities as well. So we're certainly going to cover that as part of today too.
Yeah.
Do you think for tax purposes it has more benefit to be a trader or an investor?
Look, I'll just reframe the question in the sense that you either are one or the other, rather than like one's better than the other, if that kind of makes sense. So I guess if you're kind of ticking more boxes of one characteristic, as a trader than as an investor, then you obviously just have to follow through the whatever the relevant rules that are applicable. So major distinction: as an investor, you're assessed under the capital gains tax rules. As a trader, essentially the trading stock rules apply. So I'll just quickly, Callan, do you want to run through like the key differences there? Might just hand that one over to you.
Yeah, for sure. So I guess in the investor, when we're looking at it from a capital gains tax perspective, we're looking at those isolated transactions, those sales, and we're calculating the capital gains for each of those trades. From the investor or the professional trader perspective, we're looking at it more from a profit loss. So we do have the opening balance of the assets at the start of the financial year, and the closing balance of those assets are also considered. So it's treated differently from that perspective. So if you look at the same data set and consider it from both perspectives, they would have a different taxable outcome. So in some circumstances, it would make better sense, or it would be more beneficial to be one or the other. But I think what we're saying is that it's not really which can I be, it's more which am I actually, and which should I be looking at my data through the lens of. So if you do get classified as a trader, then would process the data in that particular means. But for the most part, we work with a big basket of different users.
Yeah.
Yes,
Yeah.
cool.
Yeah. I mean, as you can see, it's quite like situational dependent. So, and there is a bit of a judgment involved. That's why it's important to get, obviously, you know, professional advice where you have uncertainty. Just to expand a little bit further, there's just a couple of differences in terms of the tax treatment, CGT versus trading stock. So losses. So if you sell your crypto asset at a loss, as under the CGT rules, you can offset those losses against other gross capital gains in that same financial year. Where you have excess losses left over, you essentially just carry those forward to future financial years. Whereas as a trader, you know, you can make losses. So obviously where you're selling your trading stock, which is ordinary income, and you're obviously you've purchased your trading stock or your crypto asset, which is a deduction essentially. Where you've made, I guess, a net loss, there is an ability to offset that loss against other income. In the circumstance that you're an individual or a partnership. So there is an opportunity to offset it against other income that you've made in that financial year. And probably where you see people prefer to be a trader when I'm making losses and an investor when I'm making gains, you know, because of the CGT discount that's available as an investor, not available to a trader, obviously, because the CGT rules don't apply. So.
Yes, and I think that's certainly worth expanding on too, because one of the other questions that we've had is, you know, how do customers, well, maybe not take advantage, but how do they, you know, I guess obtain that long-term capital gains discount? Like how does that work?
Yeah, well, I guess it does come down to, you know, for one, being classed as an investor, so more or so meeting those characteristics. And then two, holding the crypto asset for greater than 12 months. So if you're an investor, you've ticked that box, and then you've held the asset for more than 12 months. Then you've sold it. Then only 50% of that gain will be assessed for tax purposes. Now that 50% CGT discount is available to individuals, trusts, and partnerships. It's not available to a company structure. So companies don't get CGT discount. So that's always important to note because people do forget that one.
Yeah. And a question I commonly get around the discount as well is if I've bought that cryptocurrency on Cointree, for example, and transferred it to my wallets and then transferred it back to Cointree, do those transfers count? And what we're really looking at is the disposal of the asset. So if you've moved the asset between multiple accounts, then it's still under your possession. It's still counted as that within that time period. So when you sell the asset, it's really the point in which that discount is considered. And again, it kind of brings us back to the top. If we're going to look at things from the highest in, first out accounting method, you know, depending on that, you might be selling those assets that could be recognized as having the discount. So if we look at it from both accounting methods or from the different options, last in, first out, selling the most recent assets, sometimes that can work out favorably in terms of the CGT discount, but it is very much a case-by-case scenario.
Yeah, no, that's fantastic. I think some of the other questions as well that have popped up as well, which we can touch on later too, is then incorporating when that gets considered a hobby as well. But so I guess if we look at obviously seeing we're looking at tax, we also get asked a lot about GST. And I guess, from Cointree's perspective, we provide all of our customers with, invoicing, transaction exports, account statements, holding statements as well, because because we get a variety of customer types too. We onboard individuals, and then corporate accounts, self-managed super funds, and trusts, and high value traders too. So we've got quite a comprehensive level of reporting, and then exports as well to make, I guess, to make that tax time easier. But do we need to pay GST on all cryptocurrency transactions?
Yeah, it's a good question. I think there's a few different scenarios that we can look at where it might be relevant. For example, I'm aware Cointree isn't charging GST on the sale price of the assets on the exchange. So I think those transactional amounts don't commonly include GST in Australia. Where GST might be charged on a crypto transaction is, for example, if someone were to pay a professional services fee or goods and services with cryptocurrency, then at that point it's not so much a crypto trade, it looks a little bit more like a traditional purchase. So in that case, the company might charge GST as part of that invoice amount, which would then be payable as inclusive in the cryptocurrency amount. But it's looking at that kind of more traditional business or services transaction, and in that scenario GST is still charged in the purchase.
Yeah, so just to expand on that a little bit, so basically sales and purchases of digital currencies are not subject to GST per se. It's sort of the, if we probably use the example, like if I'm an accountant and someone's paid me in Bitcoin, I have to charge GST because I'm essentially, it's a sale of a good or a service essentially. So that's what you need to distinguish between. So, for example, if we use the example of Cointree, Cointree, someone obviously buys Bitcoin, they'll pay a transaction fee based upon, that's obviously how Cointree makes their money. Cointree will charge GST on the transaction fee, but they won't actually charge, if it's $10,000 worth of Bitcoin, they won't have to add 10% to that. It's just the 10% on the actual transaction fee that we charge there. So that changed 1 July 2017. Before that, the ATO said, if you're buying 10,000 worth of Bitcoin, we've got to add 10%. So good thing they changed that because it didn't really make a lot of sense. So it can get quite complex. So again, it's situational dependent on, I guess, whether you're carrying on a business or if it's more like a commercial enterprise and you're dealing with, transacting in cryptocurrency. Generally, as a trader, not so relevant. But if you're receiving payment for goods and services, then it starts to get a bit more relevant. So hopefully that helps a little bit. I know it's a bit confusing area, but generally speaking, it doesn't apply as much as people probably think it does.
Yeah, and just to address what Greg put in the chat there, this scenario where GST is being charged on brokerage, it would be the GST for the service of the brokerage as opposed to the actual cryptocurrency amount.
Yeah, correct.
Fantastic. Yeah, it's certainly something that I think is really good to be clear. So, with that GST component, I guess then touching on the reporting side of things, it's something that it's even something from my background that I know is essential, at that tax time as well. I guess we do get customers who reach out to us, and some of the viewers today may have been original Cointree customers pre-2018 where reporting was different. So we get requests all the time for different levels of reporting. But what if you don't have records of those transactions? I mean, what can you do in that instance?
Yeah, I think that's it's a big part of my job really, is to help clients kind of recover that data from the different platforms or from the wallets and things like that. And I was actually chatting to someone the other day about it, and how in the traditional accounting space, not blockchain based finance, if you're looking for a transaction record, sometimes it's a piece of paper, sometimes it's an invoice that you received in your emails, and it's actually very hard to find that data. But one thing about blockchain is that there is a ledger, there is that blockchain that keeps a record of things. So I think we actually have a bit more of a forensic capacity to go back over these data sets and piece together a bit of a logical reconstruction. So in most cases, there's data provided from exchanges, and they have various different export methods and different data formats and things like that. So piecing it all together can be a bit of a challenge sometimes, because everyone expresses their data in a different way. But there's circumstances where there is no data whatsoever, perhaps from an exchange that went defunct, or they're not able to export the data. The way we approach it is basically attempting a bit of a logical reconstruction based on some of that historical data. For example, if somebody were to have transferred their Bitcoin into a platform, and then they were to make some transactions there, and then we see a withdrawal from that exchange, the actual transactional data that occurred on exchange is irrecoverable, and it potentially never will be. So we can look at the inputs and the outputs and try to logically reconstruct a trade that took place in order for those assets to have been exchanged. And then we can include that as part of our reporting. But again, it does depend on the scenario and what kind of data is available. But I suppose the more that happens on chain, we're talking, decentralized exchanges or DeFi products and things like that, there will be a records on the blockchain to some extent. So it's really just figuring out a process to extract that data and put it into a tax readable kind of context. So yeah, I would say that keeping a personal record for every transaction you make, such as a spreadsheet or something, it can be quite a task, especially if you're trading quite actively. So I would choose an exchange that has a great data record, such as Cointree, where I know that everything's being recorded. They'll have something to fall back on, and I'm not, keeping a paper record of everything as I go along. So yeah, relying on the tools that we have available to us, making sure that we're choosing exchanges with good data access and good data formats, and keeping things to a relatively simple scale. So I know it's really tempting to create accounts everywhere and chase a particular crypto and all things like that. But when we start to integrate that data for tax purposes, it can get a little bit more challenging. So yeah, I suppose that's the approach.
Yeah, I can certainly agree. I think over the years as well, reporting has certainly really improved, and from our side, we've tried to really enhance that as well. And for any viewers who do use our platform, we provide a tax invoice for every single transaction. So there's nothing that's missed. And like Callan mentioned, if you do trade with other exchanges, make sure that they obviously can provide you with that level of reporting as well. Otherwise, I think tax time is going to be a little bit tricky. But obviously, that's why we've got Cryptocate as well to help you through that too. So another common question is, do you incur tax when you swap or trade another cryptocurrency for another? So say with our platform, we've obviously got coin-to-coin trading. How is tax incurred in that capacity?
Yeah, so that definitely is taxable, and probably a misconception that it's not. A lot of people go, it's not AUD settled or fiat settled, so it doesn't count. Unfortunately not. And this is probably the element that makes the record keeping a little bit harder. Not necessarily where you're trading on Cointree and you've got a nice record, but it's where people start to trade elsewhere or trade on a decentralized exchanges. Those swap between assets kind of exponentially increase the number of transactions where just fiat settled, if we're talking the traditional investment space, there's a lot less transactions just because you can't swap between assets. It's usually AUD settled, so it makes it a bit cleaner. So I guess basically, how do you need to treat it then? So if we're an investor, it's treated as a disposal of one asset and an acquisition of the other one. So generally you'll take the market value of the disposed of asset, you'd have the reported sale price and proceeds. And I think Cointree you guys translate back to AUD for those transactions. And then you'll have an acquisition of the new asset and its AUD value. So you'll obviously use that to compute your capital gain or loss on that disposal. So yes, it is a disposal and an acquisition of a new crypto asset. So it's a CGT event.
Yeah, exactly. And I think that is one of the common misconceptions that I do hear is people saying I haven't sold anything back to fiat, so I'm not sure if I need to pay any tax. But like Tom was saying, every exchange of cryptocurrency, even between cryptocurrencies, the gain is evaluated in AUD, so it needs to be reported. So in the circumstance where there isn't an AUD value provided by the exchange, we'll basically, look at a data set of the assets and calculate the entire capital gains in terms of Australian dollars, and then all reporting is made in Australian dollars as well. Because if it was just in and out of crypto, then it would be a much simpler circumstance. Would have a very simple profit loss kind of situation. But yeah, where a lot of the complexity arises is having to look at every single cryptocurrency transaction and look at the cost base and the sale price of that asset, and it can be thousands and thousands of transactions, so it can get pretty challenging sometimes.
Yes, I know we have quite a lot of customers who love trading alts, and certainly their tax time package would be quite a lot of documentation there. But no, that's really important to note. As I touched on before, we've got a variety of customers, and the self-managed super fund industry has been something that, particularly this year, we've had so many customers who have reached out to want to learn more about self-managed super. And I guess from our side as an exchange, our customers can have a personal account and then a completely separate self-managed super fund account, because obviously those assets need to be clearly defined as independent. Can you touch on a little bit about self-managed super and tax that's incurred, with, I guess, trading under a trust or an SMSF?
Yeah, sure. I'll take this one. Yeah, so basically, whilst the fund's in accumulation phase, so in the phase where it's not in drawdown, you haven't reached your preservation age. Generally, it's any capital gains or earnings are taxed at 15%. So it's a fixed 15% rate. And there's also a special CGT discount. So hold the asset for more than 12 months. And basically you get a 1/3 CGT discount instead of 50%. So just a reduced amount of CGT discount. And so that's basically that. Pretty straightforward. It is taxed and at 15%.
Yep. Yeah, I think you made a really good point there, just about keeping the data sets separate from each other. And some of the more challenging cases we've had to work through are where clients have had a few different entities, potentially at SMSF, and then personal investments kind of blended together, and then we have to look at the data sets and extract the data appropriately. So if someone is trying to set up a new trading entity, and specifically in SMSF, create a new account with Cointree and keep it all very very isolated, because there are quite strict reporting requirements for SMSF, and so we produce a suite of reports around that to make sure that our clients have covered all their bases. But yeah, if you keep it all in the one spot, you get your bank account coming in, going straight to Cointree, buying your assets, and then storing your assets in a secure location. Keeping that data set as minimal as possible really makes things a much more simple process for those kind of entities.
Yeah, and that's it. And I guess, just in summary, if anyone is a Cointree customer and is looking to have a self-managed super fund or a trust account, our support team and our account managers are available to help you through that process, because it can be a little bit confusing at times too. But we, like we've all discussed, those assets need to be kept completely separate, and we certainly don't want to mix things up either. So another query that comes through is getting paid in cryptocurrency. So it's certainly been, I think over the last year or so, particularly, individuals have wanted to be paid in crypto, and I guess you certainly may have wanted to have been earlier in the year as well. How is that personal earnings tax calculated as well? Is it any different, I guess, compared to CGT with all the trades and whatnot?
Yeah, so it is different. So that they just classify that as ordinary income. So if we're talking salary and wages, so an employee has elected to be paid in Bitcoin instead of be paid in Aussie dollars or whatever, then it's just recorded as ordinary income. So gross wages essentially. So if you're an Australian employer, and you are paying your employees in cryptocurrency, you will also have tax withholding obligations as well. So similar to how things are set up if you're receiving a regular wage, you have your pay slip with your gross wage and your amount that's being withheld, and then obviously the net amount. So obviously it's just important, everything needs to be translated back to AUD. So that's just similar to what we talked about, those changing between coins and stuff like that. It's all, stuff is reported in AUD. So we've just got to translate that back to the AUD value. So in conclusion, it's just ordinary income basically.
Yeah. And I suppose in the scenario outside of receiving crypto as payment for your wages, you might have staking, or you might have interest earned on crypto that you're lending. So in that sense, we usually treat them differently for investors, where we'll generally do a CGT report for those trading assets, and then people receiving income from staking or lending, etc. We look at that through the lens of income, like Tom said. So we'll do an income report in addition to the CGT report. And a key point there is when you do sell that cryptocurrency that you received as income, there still will be a CGT consideration. The cost base of the cryptocurrency that you dispose of is established at the amount that you received as income. So if you were to receive an amount from staking, you'd figure out, how much did I receive in terms of AUD on the day, and then when you sell that amount of cryptocurrency, the CGT is calculated with the income amount as the cost base. So that way you're not being double taxed. You're only being taxed on the difference from the income amount.
Yeah, and I think just quickly touching on staking, and I know we'd said we'll touch on some of the questions shortly, but we have had one that's just come through, which is, what is the best approach for recording staking income when the payment is received, say, every 10 minutes or so? Obviously the anonymous person here has just said, it doesn't make sense to record the AUD price every 10 minutes. How do we go about handling that?
Yeah, certainly. So I suppose there's two scenarios. Quite commonly these days there are staking platforms. So you can offer staking services, and you put your assets on there, and then you receive the income. And it's basically, again, kind of as though they're an exchange, up to them to produce some kind of data output that you can use for tax purposes. And then the other scenario is where we are staking directly on chain. So we've got a blockchain wallet, we have staking functionality within that wallet, and we're staking and the assets are arriving directly on our wallet. So in that circumstance, we've got a blockchain record. It'll be there. It's the blockchain ledger, kind of part of the purpose of blockchain, to have that permanent record. So we're either extracting data from another exchange platform that offers staking services, or we're looking directly at the blockchain and pulling the data directly from there. And the data set does become quite large. Sometimes we've got minute by minute payouts and whatnot. So if you were going to go through that, manually and with the pen and paper, it would take a very long time. So we set up as many automations as we can. So we can basically pull the price data for that cryptocurrency and compare it against the date that it arrived on the asset, and set up an automation in order to evaluate what that income amount would be. And to figure out what the cost base of that asset would be as well. So we're not sitting around going through thousands and thousands of lines. We've got the script and things to make this process as easy as possible.
That sounds fantastic. That really does. That sounds fantastic. I can only imagine how many transactions would come through that. Well, I think one of the final ones that I just wanted to ask is in respect of having different levels of trusts and ownership as well. Would you see typically some trusts being used as potentially to protect or manage, the assets or wealth?
Yeah, so we definitely do see that and it's usually like an evolution from, and I see this quite a lot, where individuals have kind of pulled their capital together, not in an official structure, just to see what happens and have a bit of a play. And then they'll probably generally move to a more formal structure. So generally like a discretionary family trust is a pretty common one, where you're pooling investments generally with family or other related parties, And yeah, that does offer you a certain degree of asset protection. But it's also, in addition to that, gives you some tax planning opportunities. So you have the ability to, I guess, stream income out to your beneficiaries of that trust. So a trust must have beneficiaries, and any surplus that the trust makes, so any surplus profit from its activities, must be distributed to those beneficiaries. So as a discretionary trust, for example, and there's lots of different types, so we won't go into that today, but the most common one is a discretionary or a family trust. Is probably what people hear a fair bit of, is you have the ability to split that income between your beneficiaries. So it can lead to obviously better tax outcomes than, attributing 100% of an income to one beneficiary. You might split it across 2 or 3 or 4. So that's kind of where I see it coming into play, and it's very common structure in the traditional investment space. The use of, I guess, family trusts to stream income to beneficiaries.
Yeah, that's it is really interesting, and we won't touch into the different types of trusts, but we've over our time as well, we've certainly seen different, when you do apply for a self-managed super fund account with us, we obviously go through some of that documentation, of course, to obviously find out who those beneficiaries are, and that's actually really insightful, that obviously that needs to be paid accordingly as well to that, the level of beneficiaries in that type of discretionary trust. We do have, I guess, what we might do, we may actually just start to touch into some of these questions. We've got a lot. We'll do our best to answer them, and anyone's questions who don't get answered this afternoon, we'll obviously do our best to reach out to you as well. We have had a question come through earlier today from a viewer who I'm hoping is joined part of today's session. It's quite a lengthy question, so I guess bear with me. The question is from Glenda, and it starts as, I thought I read some time ago that crypto bought before a certain date as personal use asset was not subject to CGT. I no longer see any reference to the date of purchase. So my question is, does the date crypto was bought make any difference? Now, that's the first part of the question. The second part touches on about the ATO and personal use asset, which is, secondly, I've read the ATO mention that what makes a personal use asset. It gives very limited example of someone buying crypto to buy, say, a cheap ticket, and then selling what they didn't need, inadvertently making a surplus. This is hardly how people are going to be using their crypto as a personal use asset. I'm interested in the implications of holding a relatively large amount of crypto and then just spending a small portion with potential to spend more later on, when, say, you could maybe buy a car with it. And so, and then I guess from there, while also inadvertently exchanging some crypto into cash. So does extracting some crypto at a profit affect as a definition as a personal use asset? Now, that is one big question.
That's a long one.
But I'm sure Tom and Callan, you'll be able to provide some insight on both those.
No worries. Callan, do you want to have a start on this one?
Yeah, I suppose, the personal use clause does throw a few people off, and in our experience, it's not very common for people to fall under that category. I think a key factor when considering that kind of circumstance is, how long you've held the asset for. And the longer you hold the asset for, the less likely it is that it's going to fall under personal use. You've had price exposure, and the intention behind it becomes a little bit more ambiguous. If you were to buy something, buy some Bitcoin and buy something with it immediately, then that amount of Bitcoin, likely wouldn't fall under it. But the $10,000 would fall under it, and that $10,000 threshold applies. But if you bought Bitcoin, say, a month ago, and you've spent a bit of it on your groceries or a cup of coffee, or if you bought the asset a while ago and you're using a crypto card, for example, to buy something with it, most of those will be considered as CGT, even if you are using it under that 10K threshold for personal use.
Yeah, so that the key point there is that time lag between acquiring the asset and then spending it on the personal use asset. So I know the ATO use that really simple example of buying Bitcoin and then going and buying a concert ticket or whatever it is. So, they're probably more so pointing towards that would be like in this, the same day or the same couple of, within a couple of days, rather than, I think a lot of people are sort of trying to think of this ways of tax planning and going, hey, I bought my Bitcoin, a year and a half ago, I want to try and start, using some of this up, and avoiding CGT. It's not really going to fly, because you've had that price exposure. Probably that intention when you entered into that transaction was around speculating and investing in the crypto asset rather than, in a year and a half's time, I'm going to buy a concert ticket with this. Is probably pretty hard to argue. So that's why I guess Callan sort of, sort of classified the answer at the start and sort of said, it usually doesn't apply. And it usually doesn't make a whole lot of sense to buy Bitcoin and then buy a concert ticket, to be perfectly honest.
Yeah, no, and that's, I think, well, it certainly makes, I think it really brings clarity to that as well. We actually have a couple of questions here about trading using it for like a hobby. And we've got a question from Neil, and we've also got a question from another anonymous attendee. Both of these questions, I'll read each of them out. They're both similar of nature. One is for CFD trades. When is this a hobby? And when is this profit making? What's the limit? And then another question from Neil is, I hold some crypto for a long-term gain, but occasionally do small trades for fun. Is there a threshold where trading is considered a hobby for tax purposes? So there are a couple of the ones that are relating back to more a hobby basis. Can you elaborate more on, how that might be treated, or is that similar as before?
Yeah, I guess it just kind of comes back to the characteristics. I think we pointed to the one where it's largely long-term, but occasionally there's a few shorter-term trades. Yeah. That's okay as long as like the, in general terms, the bulk of the holdings is held for like longer-term, capital appreciation. And I do understand the fact that it is hard to prove intent sometimes. So I guess it's key around like documenting like your thoughts or what you're thinking, or just documentation is key if you were ever to get asked the question by the ATO. And I think the other one was around, was it hobby? When is it a hobby, or
when it's hobby and profit making
enterprise? So again, just looking at those characteristics of that profit making intention. Like, you're obviously entering into that activity. You're not entering into it for the, for a bit of a punt and a bit of fun. Like you genuinely probably are intending to make money. And then looking at how well are you organized? Is there any method to your madness? Are you like, do you have a trading strategy, or are you kind of like just, buying and selling based upon, a whim or that sort of thing? So it rather than, I guess, pushing you into the hobby bucket and you're like, oh no, it's all good, it's just a hobby, so no tax applies, you probably might get pushed from being a trader into an investor, for example. So assessed under CGT. So that's really short answer, you will get probably classified as one or the other. You just need to really just make an assessment of the characteristics. And then when you're unsure, just speak to a professional, and they'll generally be able to, I know it's not necessarily black and white, but they'll be able to give you a fairly good professional opinion on, what your situation will fall within.
Yeah. No, fantastic. I've got another one, which we may have touched on a little bit earlier from Jeff. Is a swap from, say, BTC to wrapped BTC, so WBTC token on Ethereum, a CGT event?
Yeah, I think that's a great question. It somewhat falls into the loan category to an extent, and I think a way of looking at it as well is considering MakerDAO CDPs, for example, where you can deposit your Bitcoin and receive receive DAI stablecoin back. So in that scenario, you aren't getting rid of the asset; you're still in ownership of it. And in that MakerDAO scenario, you can receive it back by cashing in your DAI, for example. So in that scenario, the disposal or the storage of the Bitcoin in that contract, and in this scenario as well, the storage of that Bitcoin in the wrapping contract, isn't necessarily disposing of the asset. It depends on the circumstance and the code of the contract in some circumstances as well. But you're not necessarily selling that Bitcoin. You're just kind of putting it in a position and receiving something for it. But the consideration would be for the wrapped token itself. So if you were to sell that wrapped Bitcoin token, or you were to sell that MakerDAO DAI, then that would be a CGT event. So yeah, I was chatting to a client the other day about it, wanting to take out a Bitcoin collateralized loan, and they were saying, I could do it and receive USDC, for example, back, and would that help? Would that mean that I wouldn't have to pay the CGT on the disposal? And for the loan amount, yes, that's correct. You're not disposing of the base asset that you're using as collateral. But if you do sell that cryptocurrency, then it still falls into a CGT event. So in that scenario, if you were to get a crypto collateralized loan, you'd want that to be in Australian dollars, which means that you could use it without incurring a CGT event.
Okay, and we've actually had another question that's quite similar as well, from another attendee, which is swapping Ethereum to Ethereum 2 taxable. So example, when staking Ethereum 2.
Yeah, in the circumstance where you are exchanging an asset for another, I do believe it is taxable, which is, it's unintuitive considering that it is kind of the same asset. And if somebody was in the crypto space, they understand it's not really a voluntary swap. It's not really a profit-making exercise, but there's still a disposal occurring. So you'd be realizing the Ethereum that you had and establishing the new cost base of the Ethereum 2 based on the sale price. In that circumstance, I believe. Yeah.
Okay. We've got another one quite similar too. So from another anonymous attendee. So when providing liquidity in AMM like Uniswap, asset is swapped into a new asset that gets the fees. Is that swap activity also taxable? With the fees, these are counted as income, or are they capital gains when the AMM asset is to be swapped back to the original asset?
Yeah.
Context.
Yeah, no, another great question, and it's the kind of question that I really like considering, because it is really on the fringe. I don't think the tax office has really provided any guidance around this. So in the way that we consider it, you have an AMM protocol, and you're depositing, say your Ethereum DAI pair into that contract, and you're receiving a token back. A placeholder liquidity token on Uniswap, for example. So it is actually a disposal in our consideration when you are putting those assets into the liquidity pool, and you're receiving the liquidity token as a result. And then you can kind of go on and, stake that liquidity token, do your liquidity mining, and different rules apply to the income you receive from that. But then the interesting thing is when you're cashing that token in again, due to the impermanent loss of the liquidity provisioning, which means you won't actually receive the same assets back. So then it would be basically a consideration of that placeholder token, the liquidity token, as a disposal for those new assets, and then evaluating the cost base of those new assets based on the disposal of that liquidity token, which, I mean, it's it's pretty far out in terms of a new field in taxation and finance. So yeah. I would love some greater clarity around it. But yeah, Tom, did you have anything to add to that one?
Yeah, no, and this is the tricky part, right? I guess short of the ATO creating its own set of rules for crypto, everything just kind of needs to fit within the existing tax laws, and that's kind of what you see here. The treatment is essentially just fitting within existing CGT laws or trading stock rules. So whilst it can sometimes seem quite counterintuitive or I guess quite onerous in terms of the record keeping or administration around this, I guess it is what it is. So we've just got to work within the rules as they currently stand. Yeah, look, might be nice for, swaps between coins to get some kind of rollover relief. But, as it currently stands, it just, we sort of just have to work with what we've got.
Yes, I think over the years as well, cryptocurrency certainly been an exciting challenge, I'm sure, for the ATO to be able to work through as well with some guidelines. No, it's some really, really interesting questions here. I've had one from Stephen, which says, are you able to give a list of or a number of reputable DeFi entities that provide crypto loans in Australia?
Short answer, probably not off the top of my head. I know there are a few companies around. I'm not sure if they're working directly in the investor space. I think a few more, it's easier to provide these kind of services in a B2B sense. There are certainly DeFi protocols. So yeah, DeFi entity is kind of a little bit of a misnomer perhaps, in that there are DeFi protocols you can certainly get crypto loans based on. But the key factor I think we talked about was the AUD, receiving the AUD and not having to incur CGT. So you can certainly, get I would say MakerDAO, is one of the most tested protocols at the moment. So you can get that loan from, that particular DeFi protocol, but it might not help you to avoid that CGT. But in terms of companies that are currently providing consumer crypto-backed loans, I'm not sure, and I'm not sure if they're, no names spring to mind, unfortunately. Sorry.
No, that's okay. I think it's good to get that level of context as well around those types of projects. Look, we've only really got maybe 5 minutes left, so I'll touch on one more key question here. We've got two that are similar of nature. So we've got one from an anonymous and one from Kuhn, which I'll peg into the one basket. My apologies if they if they don't quite go this way. But a couple of ICO projects that someone's invested in have obviously potentially now not been successful. The coins aren't listed on an exchange anymore, and this was back in 2017 and 18. Can I now claim the cost base calculated in AUD as a loss? And then the other question, a little bit similar, which was, if you potentially invested in something that may have not have been as legitimate without, that company being registered, and now it's suddenly disappeared, how can you claim those as, can you claim them as losses?
Yeah. So short answer, if a coin's been delisted, then it's, it's likely able to be claimed as a loss. In the circumstances of scam similarly as well. And I suppose, again, the blockchain providing us a great record, so we can look back and we can see the assets in the wallet. We can see if they're being traded anywhere. And if you had purchased an ICO, for example, and you're trying to establish the cost base, we can look at your Ethereum wallet potentially and see that transaction of Ethereum going out to the contract address. So we'd be able to figure out, what the cost base was in that scenario. But yeah, sadly there are scams and different ways that people can lose their funds in crypto. And, I've spoken to quite a few people that have unfortunately been scammed. And in that scenario, we'll look at the data that's provided. We try to validate, as much as what they're telling us with data from the chain or from their wallets and things like that. And then we can usually write that off as a loss and include that in an end of financial year report.
Yeah. Yes, and I think, like we've all mentioned as part of today's conversation, it's extremely important, depending on who you trade with, to make sure that they are a reputable, registered business. And particularly in Australia, all digital currency exchanges need to be, registered with AUSTRAC as well. So, it's, best to do due diligence where you do trade. I'll touch on one last question and then we'll wrap it up, which is just related to gifting. So if you did receive crypto as a gift or an airdrop, and it's only ever been used to purchase personal goods, is there CGT applicable?
Yeah, again, we'll probably just touch on that time lag between, I guess, getting the crypto as a gift and then using it to just purchase the personal goods. So look, there's a chance that if it was purely you got that as a gift and then you paid for whatever, then certainly there is a chance of getting in under that personal use exemption. If you do hold it for a longer period of time, there may be an argument that you're holding to speculate and you might fall under that investor category. So short answer, it depends, but if you got rid of it and within a couple of days, you're probably pretty safe.
No, thank you for that, Tom. I think that'll be the end of a lot of our questions today. I'm sorry if we didn't get to answer all your queries. Again, as I've touched on when I conclude as well, all of our attendees will get an email at tomorrow about today's session. So you'll have contact details as well to reach out to if you've got any questions as well. And we actually have had some Cointree platform related questions as well about how to access our transaction and tax reporting too. Just for anyone who is a Cointree user, we'll provide some more information on this, but all of your tax reporting is actually available from your transaction screen in an export option. And those files can also then be exported and provided to the team at Cryptocate as well to be able to help with your tax reporting. But we'll make a note of that to be able to give some more information on those too. But wrapping it up, thank you so much to everyone for joining us today. Thank you, Callan and Tom, for your time. It's been so insightful. I've learned so much more as well about crypto and tax. And yeah, thank you so much for joining us today.
Yeah, our absolute pleasure. And yeah, if you have any further questions, feel free to reach out to me, Callan at cryptocate.com.au, or get in touch via our website, and we'd be happy to answer any follow-up questions.
Thank you so much again. And as I mentioned, all attendees will receive an email today. And from the Cointree team perspective, our customer support team are available 7 days a week. And we've also got account managers. And if you fancy reaching out to myself as well, my name's Jess Rendon, and my details will be available too. So thanks again, everyone, for watching, and have a lovely afternoon.
Thank you, everyone.
Thanks, guys.
Thanks, everyone.